I've had clients come to me and be like, Matt, I got $150K in my IRA. I can buy one property with cash that I can get returns on and I'll have no UDFI. Or I can buy 3 rentals and I'll leverage them with debt, but I'll have UDFI on the 3 properties. What should I do?
Go buy another Airbnb baby with that, but also use 50 to 60, 70 grand of that and do your 401k contribution. Put money in your S Corp from the loan, which you can do as a capital contribution, and put that contribution you just put in your 401k directly into your S Corp, into your 401k.
Welcome. We're excited for today because this is open forum. We've got your questions on how to self-direct your retirement account, how to operate a solo K. What can you do? What can't you do? We're excited for it because this is the People's Show. This is where we can answer your questions and know what's on your mind. And by the way, you can get to directedira.com/podcast to ask your questions. Make sure you're throwing them in there. Some of you have written novels in here and really need a tax consult with a lawyer.
I guess I thought you were reading an ebook on your pastime.
I know. I was like, good Lord, I'd have charged you 2 hours of billable time for this in the law firm. Come on.
See, now you're mocking our listeners. Don't do that. So
I'm just saying there was a couple in there. Just know we're going to skip those. Get over to our law firm, KQS Lawyers. We can help actually advise you and get into the nitty-gritty on your tax planning. But let's hit some of these questions here. I know you've got one on solo K maybe out of the gate. You want me to go first?
Well, you're scaring me with that book I'm looking at over there.
I'm skipping that one.
Oh, okay, for now.
I'm skipping that one. And I got a good one though. If you want me to lead off.
Yeah, go ahead. Okay. Lead it off. I've got one here too.
This was Dan D'Angelo. He said, hi, Matt and Mark, great content. Well, thank you very much. Currently assembling my own trifecta, which I've already paid for with you guys. And he had a few questions for the podcast. Dan, I'm going to skip 1 and 2. I'm going to go to number 3 on your list because it does actually apply to the podcast. All right. Here, she said, traditional and Roth investing in leveraged multifamily. I'm planning to invest some traditional IRA money into different multifamily investments with a different sponsor. I would like to pay, I understand you have to pay tax on a leveraged percent of both the cash flow and the capital gain. Can you please write out an example of this and the math of how this plays out? Does it matter the benefits, disadvantages if you use Roth IRA money? Okay, great question. And this is something we have a lot of people using their IRAs or solo Ks, we'll talk about that here in a second, to invest in a real estate deal that might be leveraged. Whether you're buying a single family property and you're getting a non-recourse loan, or you're investing in a syndication with a private fund that uses debt to leverage the fund. So let me give the easiest example, and we'll throw some math in here. Dan, you did ask for it. He asked for some math here. So let's say you're buying a property for $100,000. Let's say you got $40K in your IRA, and you're going to go to a bank and get a loan for the other $60,000. Now you're going to want to use a bank that knows what a non-recourse loan is for an IRA. Okay, there's a list on our directedira.com under a resource directory. There's a number of banks there that will lend to IRAs and 401ks buying rental properties. Generally, you're going to need 30 to 40% down. But let's run with this example so I can do the math. You put $40,000 down, $60,000 in debt. Now the IRS looks at this and they say, all right, 60% of that investment is not IRA money. We'll let you do it. We'll let you buy more assets than you otherwise could, but you're going to have to pay tax on profits of 60% because this deal is 60% leveraged with debt. So let's say 2 years later, you sell the property and you sold it for a $30,000 gain. Let's say you had $10,000 of expenses, so you really only made $20K at the end of the day. The IRS is going to look at that and say, all right, this was 60% leveraged at $20,000. So 60% of that $20,000 is subject to this tax called UDFI, unrelated debt financed income. Okay, so let's recap this where we're at in the numbers. We had a $20,000 gain after I took $10,000 expense. 60% is leveraged with debt. 60% of $20,000 is $12,000. Okay. Now I apply the capital gains tax rate. 20% of $12,000 is $2,400. Okay. So in other words, I had a $20,000 gain go back into my IRA and I had to pay $2,400 in tax because of UDFI. Not a bad deal. I was able to buy a $100,000 property when I only had $40,000. Now this is the tax you get on gain. Now, Dan asked, what about is your cash flowing as well? Well, I'm going to take depreciation expense, my mortgage interest. A lot of times, whether I'm buying a single family rental or I'm investing in a syndication, even if I'm cash flowing the property, there's no taxable gain. I'm getting a K1 with a loss in my syndication typically year to year, even if I'm getting cash flow back because they're expensing everything they can. They might be doing a cost segregation in the multifamily deal for all the taxable investors that don't want taxable income coming through. So where we really see this UDFI is not year to year on the cash flow. It's the same equation I gave there, except you pay the UBIT rate that can go up to 37%, not the capital gains rate of 20. So where I do see clients that use an IRA leveraging with debt where they do have to hit this tax is sell of the property when they still have a mortgage balance. Now, I've got a whole chapter in my book, the Self-Directed IRA Handbook, that goes over this and how to calculate it. It can be a little confusing. So just know you can run to that chapter 15, I believe.
Wow. That was a hard question to lead off with. And many of you listening.
Anyone else listening still?
I hope. That's a hard one. Now, I need to probably bite my tongue because this next one is tricky. But I think there might be some.
This is what people show up for. They show up for the hard stuff.
They pay for the hard stuff. Okay. Yeah. So this is from anesthesia, and I don't know if this is an anesthesiologist or someone that's just under anesthesia because it's a good one.
Let's judge after we hear the question.
Yeah. All right. Okay. I'm gonna. The question, the facts of the matter kind of roll out throughout the question, so I'm going to rephrase the question a little, and I'm going to give the facts for us here. Anesthesia bought a property in his S-Corp that he is going to Airbnb, and he said with no loan. So he bought a property with cash in his S-Corp to Airbnb. Then we're going to have he wants to transfer that property into his solo 401k as his full contribution for last year. Okay, now, and then he wonders if it's going to be subject to UBIT and UDFI because it's an Airbnb. Now, anesthesia, you got 3 to 4 different major issues going on and concerns that I have that I want to help guide all of you listeners on this type of situation. This is really powerful. Matt's already, spoiler alert, given away the answer to the core question of his is, I want to transfer a property that's paid for and do that instead of cash and put it in my solo 401k. Now, this is a common question. A lot of people are like, well, I've got crypto or I've got stock or I've got real estate. Can't I just put that in my IRA or my Roth or my 401k instead of cash? I mean, it's equivalent. We know what it's worth. It's almost like cash. Can't I just contribute that property into my retirement account instead of cash and call it good? I'm not going to put in any more than my limit, but I just want to do property instead of cash.
You can only contribute cash to an IRA or 401k. That's the only thing you can make as a contribution, no property. What does he say on The Princess Bride? The Prince Bride, he's like, you've made one of the classic blunders.
Oh, yeah, one of the classic blunders.
You've made one of the
Not only this,
blunders.
but to play with a Sicilian.
Everyone knows you never win a land war in Asia.
Everybody knows that. Oh my gosh. I got to watch that again. That was one of the classic. All right. So now everybody out there, we get that question a lot. You've got to sell your crypto first. You've got to sell the stock first. You've got to sell the real estate first. Turn it into cash. Then that's what you get to contribute. And I know you're frustrated out there. You're like, well, I want this property in my retirement account. Okay, let your retirement account go buy a new property, learn from the one you just did, and do both. Do both. Don't sell your property. Keep it. But the next one you buy better be in your retirement account. So anyway, now here's some other issues I want to forewarn you on. You do not want your Airbnb in your S corporation. Please transfer title right away. It looks like you may have you said he bought the property in 2024. So that's good. Get it out of the Airbnb. I know what you already think because you asked later, is this going to be subject to UDFI? Because it's a short-term rental, you think it's subject to self-employment tax and should be in your S corp. No, absolutely not. Definitively no. An Airbnb is still considered passive long-term rental income and should be on a Schedule E with a 1065 if you have an LLC with a partner or in an LLC. Do not put it in your S corp. I teach on this constantly. You can meet with any of my tax advisors or tax lawyers if you need to yell at someone and get verification. I stand behind that. That's a fact. Do not put your Airbnb in your S corp. Get it out of there. Also, you bought an Airbnb for cash with no loan. not a good use of the money. Your ROI is going to be in the toilet compared to using leverage properly. Please. And you're like, well, I don't want a loan. Have you seen the interest rates? I get it. I will win the argument every time if you put down 20%, even 30%, and go buy 2 Airbnbs with that same money. And by the way, I own Airbnbs. I own long-term rentals. I know what I'm talking about here again. Unless you're 85 years old and you want to just collect rent and never build more wealth or real estate, go ahead and buy it with cash. It is not a good move for any of you that are trying to scale and buy real estate. Please use leverage. It is in your best interest. It's safer. It's better for asset protection and tax planning and wealth building. So go rip some money out of that property that you already own with no loan. Get it in an LLC. Get it out of your S Corp. And you're not going to have UDFI or anyway, because it's not subject to self-employment tax. It's passive income.
Yeah.
So Anesthesia, I love what you're doing. You're just, please do a consult with one of my tax lawyers and unpack all of that, because you're sitting on a gold mine and you've got some great ideas, but you're kind of in the wrong lane. Let's help you out.
Yeah, and I think, let me just even hit, because you're talking about your solo K. By the way, just that last question about UDFI, solo 401ks don't pay UDFI. So you can leverage the property in a solo K and have that debt, and you actually don't pay UDFI that we just talked about in the prior question for IRAs.
You want a strategic strategy here? Take that rental oh, this is so good. Take that Airbnb that has no loan against it. Let's say it's worth 500 grand. Go get it's not even a HELOC, because you don't even have a first mortgage on it. So go pull out a first on it. Maybe pull out an 80-20 loan. Pull out 80%. So you're going to pull out maybe 300 grand, 400 grand. Go take that 400 grand. Oh, this is so good. Go buy another Airbnb baby with that, but also use 50 to 60, 70 grand of that and do your 401k contribution. Put money in your S Corp from the loan, which you can do as a capital contribution, and put that contribution you just put in your 401k directly into your S Corp, into your 401k. So you're going to fund your 401k with the loan on the Airbnb. Then go out and get a non-recourse loan inside your 401k to buy another Airbnb that is not subject to UDFI because it's a 401k. Now you end up with 3 Airbnbs, starting with the 1 Airbnb that's paid for right now, and you move 1 property into your 401k, and you get a 401k contribution. You knock it out of the park.
This guy just got colored. That's what we call that. He just got
That's called a coloroscopy.
He's got a coloroscopy.
It's all good.
Yeah, so that's a great strategy, and I think the only thing, remember, you must have earned income in that solo K to make that contribution. But as long as you have earned income, you'll be good on that. All right, let me hit the next question here. All right, let's see. This is from Dennis. Dennis says, hi, Matt and Mark. I've had a self-directed account for several years, but I have a situation I've never had before, and I don't know what to do. Mm-hmm. He says, I typically invest in notes and recently had a performing note, a note where someone is paying on time, become a non-performing note. Someone's not paying him back on this note. So the account has lent money, secured on a property, and now he says, I basically ended up with the property back. He had to foreclose and take the property back. The property is trash and it needs work before I can sell it on the open market. He says, I believe all the work needs to be done by contractors and funds from the solo 401k. I do have a checkbook for this account, but it's becoming difficult to work with places like Home Depot to buy materials and contractors who when I say I need to pay by check. Can I get some type of credit card just for the solo K or some type of account to make it smoother? I know people don't do fix and flip. He says, I know some people do fix and flips in their 401k or their self-directed account. How do they typically pay for supplies, especially when they live out of state? Thanks so much, Dennis. Great question. Easy answer. Just get a debit card. Just get a debit card.
Why do I do a debit card? Yeah.
Just do a debit card associated with the checking account. Titan Bank, who we work with on a lot of our solo K clients, that have a trustee checking account for their solo K, or your IRA LLC checking account. You can get a debit card associated with it. And so don't get a credit card, though. The problem with a credit card is they typically require the personal guarantee of the owner of the account, whether it's a solo K or an IRA or IRA LLC. And giving the personal guarantee could cause this extension of credit prohibited transaction. But a debit card is easy. It'll be linked to the checking account, and that is how the clients are doing the fix and flips that you talk about, and how you'll be able to solve this problem to either just pay by phone, pay at Home Depot, pay the contractor out of state that's going to require some money up front before they get going.
All right. Great question here. I'm excited about Robin. She asks, your company helped us create 2 IRA LLCs. One contains my IRA, my Roth, my husband's IRA, and his Roth for a total of 4 members. Love Robin. She's so organized in her question. Percentages are not equal, which means those accounts put in varying amounts to create the LLC. We purchased a rental house, then sold it for a great profit 6 years later. Now the money is invested in T-bills. Well, whatever. My husband turned 73 this year, and he needs to take an RMD, required minimum distribution. Now, for those that don't know, once you turn 72, 73, that target's been moved out with legislation in the last couple of years. You have to take a distribution out of your IRA, not your Roths, because the government's like, you got to get rid of that IRA before you die. We want to tax it. So that's called a required minimum distribution. It's based on actuarial tables, blah, blah, blah. So she says, I'm only 66. I don't have to take RMDs, but he does. And she doesn't say this, and he doesn't have to take RMDs in the Roth, just that IRA. So for that one member, his IRA is required to take an RMD. Can we do a book entry for the RMD, reducing his IRA percentage without having to distribute any cash? So his account would go down, and we would distribute a little bit of ownership to him personally as if he took money, but he didn't take money. He took an in-kind distribution. And he'll get taxed on it. We'll come up with the dollar amount. We'll get an appraisal. And the other accounts would increase in percentage. No, okay, everything was so good. First, can she do an in-kind distribution? Could she distribute a percentage of the LLC? Sorry, his IRA percentage would go down, and they would distribute part of that IRA percentage to him instead of cash. That's okay.
That's okay, but
now, remember, you're now going to have 5 members because you're going to distribute part of that ownership the IRA had to him now. That's the requirement. He's got to take a distribution from his IRA.
He's personally,
so he's going to be a personal owner now. So now you're going to have 5 members to the LLC. Your IRA, your Roth, his IRA, his Roth, and him personally, because his IRA gave some of the ownership to him. And that satisfies the RMD. You'd get an appraisal. You'd come up with a value for that IRA percentage, and then you would give it to him personally. That would be my answer. Is that crazy? I've got some other ideas. Are we okay? No.
That's option number 1.
Yeah,
that's option
that's
number
option
one.
number 1.
And I'm just going to say it just because I know Mark makes it sound easy. This is not easy.
Okay.
It's going to take an appraisal. You're going to have to redo your operating agreement for the LLC. You're going to have to membership transfer for the in-kind distribution, and you're going to have to do this again next year. Yeah. So I've
got some other options.
Okay.
What's your option 2? You give your option 2 first.
Here's the problem with this, and this is a downside to the multi-member IRA LLC. I'll just be 100% candid on this. This is why I don't like multi-member IRA LLCs.
When someone's that age.
When someone's that age and they want to take RMD, and everyone else is like, but we don't want to take money out. We want to keep all of our money in. Well, this is what you get.
Yeah. Now, so option 2, what Matt's saying is, this is in T-bills. Super easy. You've got a dollar amount that's in this LLC. Figure out what his RMD is. This is option 2. I've got even one that's easier, option 3. But option 2 would be, let's say his distribution is $2,000, based on his age. You may think it's worse than it really is.
Yeah, it's usually like 4% at first. So if his IRA is $100K, he's got to get $4K out that year.
Yeah, so it's not that bad.
And by the way, if he has other IRAs, you can satisfy the RMD.
Whoa, you're talking option 3.
Okay,
chill.
I stole your thunder.
No, because no one heard you. I overrode you. Okay. Damn it. It's really hard to work with you here.
Robin, Mark's going to send you a bill at the end of this. Okay, he's getting after it.
Okay, option 2 is, let's say he needed $4,000 under your math, 4% of $100,000. Just find out what that pro rata is based on his ownership percentage, and just do a distribution for all the other 2 Roths in the IRA. And it's not the end of the world, and just do a distribution for everybody. Now, by the way, when you do a distribution for everybody, it just goes back to your Roth and your IRA and his Roth. His IRA is going to have a second piece. So you're doing a distribution from the LLC to the IRA members, and then his IRA of those 4 members has to actually send him personally a check at 1099-R, and he's got to pay some tax. The other money can stay in your Roth. Keep investing in it. His Roth, keep investing in it. Your IRA, keep investing in it. It doesn't mean it's going to you personally, but there's a second step that goes to him personally. Now, the third option, I'll just say it quickly. Matt, you're so smart.
Sorry.
I was trying to feel smart, but you stole it. He needs to take an RMD to satisfy the value of all of his traditional IRAs. He might have a traditional IRA sitting somewhere else. Take the RMD out of that and leave this LLC alone. You can do that. You don't have to take an RMD out of each IRA of your husband's or any of you that are 73. You just have to add up all of my traditional IRAs. What's that worth? What's my RMD? And you can take it from any traditional IRA, and you don't have to go play around with the assets and percentages over here. So that'd be the third option.
Yeah. Yeah, I mean, you nailed them all. That's the options, Rob. And man, Mark, that's a comprehensive answer.
Thank you.
I appreciate
fine,
it.
Sir.
This is my nice way of saying you took forever on that.
What? You took longer on your other ones.
I know. I did start with UDFI, so who am I to talk?
I'm still getting back square.
Are you still back on what's 60% of this and 20% of that? And okay.
Ooh,
all right.
Okay.
Anthony had a great question. This is Anthony from South Carolina. Says, gentlemen, I'm 54. I have an old 401k with a previous employer, which has about $80,000 in it. I'm done with the equity and bond markets. I already have enough exposure there. I'm currently working and contributing to another plan with even more going into a Roth 401k. My fiance and I want to start a coffee shop in a location that desperately needs one. The opportunity is there. However, with a self-directed IRA, I'm unable to fund this venture. You are, if you want to work in it. You could fund it, but you couldn't work in it. But I was reading about ROBs. Could you kindly give your opinion on ROBs? Is there any other way I can invest in this venture outside of an SBA or other investors? Are there any loopholes? Okay, let me give you the three options, Anthony. And we've done a webinar on starting a small business with your self-directed IRA. And these are the three options. I'm going to hit them quick. One is the ROBs, which you already talked about. The ROBs is, and you know what this is, Anthony, but for everyone else's sake, it requires a C corporation, a special type of 401k. We don't love it because now you're a C corp in the business. The 401k owns it. I've probably set up about 30 of them in my career, and about 10 years ago I stopped because 28 of those 30 clients didn't like it.
Yeah.
Now, you can do it.
You can do it. Go over to Guidant.
Guidant would be the one to go to.
They're out of Seattle. Go to their website. They're great people over there.
Even your typical accountant or CPA or lawyer is going to be like, what is this? Use them. This is all they do. But that's option one. I don't know that I love it because it requires a C corp. You got corporate tax. It's a more complex structure for a small coffee shop and $80K you're talking about here. I probably wouldn't do it. Option two, just have it be in a self-directed IRA. Send this $80K to a self-directed IRA, have that invest in the coffee shop, and you can be management and supervisory, but you can't go work in the coffee shop. But it sounds like you got a job anyways, Anthony, so maybe that's okay. Now, maybe your fiance is going to become your future spouse, and you're like, well, she's going to work the business. And that would cause a prohibited transaction problem too. So maybe that's where you're at. I don't know. Okay, so that's option two is you can have your IRA invest and put money in the business and own it, but you're not going to be able to work in it and take a salary. It's not your day job, nor would it be your future wife's.
And can I throw out maybe, I don't know, a third option, but just a consideration. When you're out there.
Option three is a great one. I got option three.
You got a three. I'll throw out a consideration, and that is we've helped so many clients over the years buy businesses. You have to be careful when you're buying a business. Are you just buying a job? When you're analyzing this coffee shop, say, how much is it going to cost to put someone in there to run this as if you were there, and put that in the equation of, is this a good deal? Because if you have to work it to make the profit you're expecting, that's not a good deal. So really even step back before you even talk about, am I going to do this deal with an IRA or not? Do I have to work in this? How much would I pay myself? Is there a higher best use for me keeping my day job or doing something else? I think that's always a consideration people don't think about. Oh, I want this coffee shop. It's going to be so cute. I'm going to buy it and I'm going to work in it. Did you just buy yourself a job?
Yeah.
Anyway.
Yeah.
Third option?
Okay, option number three is, here's what you're going to do, Anthony. You're going to set up an S corporation, a brand new S corporation. This could be you and your fiance. And that S corporation is going to set up a solo 401k.
On day two.
On day two. You're going to roll this $80,000 from your old 401k into the new solo 401k.
On day three.
On day three. And on day four, we are going to take a loan from the solo K to yourself.
That's day 4. See, I get to see the days.
Yeah.
You stole my thunder again.
Like we're creating the world here.
Yeah, day 4 is that loan.
Day 4 is the loan. You can take half the balance of the 401k not to exceed 50K. In this example, half the balance of 80,000 is 40K that you're going to get to yourself. Now you have 40,000 out of the 401k. You got to pay it back over 5 years, prime plus 2% interest rate, at least making quarterly payments. But
tax deductible.
Now you've got 40K, and you're going to expense those payments, by the way. Now you put that 40K into the solo K.
Into the business.
Into the S Corp to go purchase the
day
coffee
5.
shop, buy your inventory. Okay. What are we doing on day 5?
Well, day 5 is then you take those loan proceeds and capitalize the business.
Capitalize the business, okay.
And go buy the business and now you've got half of the capital needed from the 401k as a loan, and you can own 100% of the business, take some tax deductions and write-offs, not have this complexity, and maybe you bring on a partner for the other 40K, or you find the 40K somewhere else, or a small business loan or somewhere else.
Exactly.
Let the 401k subsidize half of the business through this solo 401k loan strategy.
Perfect.
Boy, bam, that was sweet.
Yeah, and that's the easiest. That's much simpler to execute and pull off than the ROBs, much cheaper, much better long-term tax benefits because you have an S Corp instead of a C Corp, which you'll save taxes on as you're running the business. No restrictions on your spouse working in there, your future spouse, you knock yourself out. You guys can work there. It could be your side hustle until this coffee shop turns into Starbucks. So
there you go.
That's the strategy. That's what I do, Anthony.
Okay. Question from Jimbo MTL says, I have 2 sources of income. One is U.S. passive income, and then 2, foreign compensation. So what do that mean? And then he says, the foreign compensation is completely offset by FEIE, which is foreign earned income exclusion. So if some of you are like, what the hell is this person doing? They might have a rental property in the U.S., and they have a W-2 working in another country, but they're a U.S. citizen. When you're a U.S. citizen, you have to pay tax on your worldwide income. But if you earn that income in another country, so say they live in London, they have a W-2, they get a foreign earned income exclusion up to a certain amount, but then they also have rental income back in Florida or whatever. So they've got, this person has income earned in another country, not paying U.S. tax because of this exclusion, and then they've got some passive income. So pretty cool. And then they said, now this is a really good question for a couple reasons. The resulting AGI is in the range, so they have AGI, permissible for a Roth contribution. Is that permitted? Now so they have earned income, but it's foreign earned income. I can still contribute to a Roth with foreign earned income, right?
I don't know.
That's a good one, right? I think
Jimbo. Jimbo stumped me. I don't know that.
Yeah.
Answer that question.
But now here's the other issue, though, that's a subtle one. He says the resulting AGI is in the range permissible for a Roth contribution. Jimbo, you don't know about the backdoor Roth as well.
Yeah.
Because see, what you're worried about is there's 2 issues, and you missed the first issue that we're stumped on, and the second one is a non-issue. You're worried that if I make too much money, I can't do a Roth contribution. You can do a backdoor Roth. So please listen to some of our prior podcasts on the backdoor Roth, and your income issue is not going to matter. The real question you have, and I'm dying to Google it now, is can you use foreign income to make a Roth contribution? It looks like you already
got the answer. Yeah. So if you're an American expat, you have earned income left after
the FEI.
After the exclusions and deductions, you cannot contribute. You have to have income after.
So if you
the
have
exclusions
income
and
after
deductions,
the exclusions,
yes, then it counts. So if you exclude all of your income from the foreign earned income exclusion, you won't be able to contribute to an IRA.
Now here's the tricky part: when you say the resulting AGI is in the range permissible, that could be passive income for you. I don't care about that. I care about your earned income. Because in order to contribute to a Roth, you have to have earned income. Passive income doesn't count. So you're being really tricky in your question too, because you goes, I have resulting AGI. Do you have resulting earned income over and above the earned income exclusion? Then you can contribute to a Roth. And I don't care if it's $1 million, use the backdoor Roth. So don't worry about income levels. You want to worry about your earned income over and above the foreign earned income exclusion, and that's going to open the door to the Roth. Great question.
Yeah.
Wow. Really, really, really good. So if you need to, make an appointment with one of our tax lawyers to kind of unpack that for a half hour to an hour. You could really use a comprehensive tax consultation, I'm sure, especially if you have U.S. passive income. For around $1,600, any of you listening, those tax law comprehensive consults are so awesome because you can use that and take it to any professional or have us help implement maybe some of the strategies we uncover. All right, maybe a couple more questions.
Okay, I got one more. Maybe we'll wrap it up the last two questions here. And I don't know if this is we had a lot of UDFI questions here, and so I'm not trying to create a theme here, but this is from Gerard in Massachusetts. He says, if I use a self-directed IRA to purchase a property with an existing mortgage and make payments on that until the account sells it, will I pay UDFI tax even though my account never took out the loan? So you're buying a property subject to the existing mortgage and you're doing it with your IRA. Yes, because the acquisition of the property included the debt that you would agree to continue to pay the debt, that is still debt leverage benefiting the IRA, having it purchase an asset more than it could. Let me make a couple other points, though, about UDFI that I wanted to make on the last one.
Can I ask you a question, too? Because it's not acquisition indebtedness, or is it? Because he bought it subject to? He's trying to get around that because it already existed.
Yeah, here's the tricky thing. The tax code uses the word acquisition indebtedness is subject to this UDFI we're talking about. But then you go read the definition of acquisition indebtedness. It's new debt, improvement debt, a debt taken subject to the property when you acquired it. It like pretty much brings in everything that has nothing to do with acquisition indebtedness if you like took a strict like the dictionary interpretation.
Yeah, gotcha.
So
Irish.
Yes, unfortunately it would include this, and I've had to research this over the years. So
I have a little subtle thought too, but you go first.
Let me hit a couple things that I think are important for UDFI. First, there's a strategy of paying down the loan and then selling the property with zero debt, and you have no UDFI at the time of sell. When you sell a property, the IRS looks at what is the debt. They look at the date of sale and how much debt was on the property over the prior 12 months. So we've had a lot of clients pay off the loan, hold it 12 months with zero debt, and then sell it, and they have no UDFI at the time of sale.
I love it. I got a second one.
Okay. Go ahead.
If, what's their name?
Gerard
has a small business of any sort of 1099, please go create a little solo 401k. You were probably going to go there.
Yep, that's a good one.
But create a solo 401k for your little side hustle, and roll this IRA money into your solo 401k, and do the same deal. But with the solo 401k, no UDFI. No UDFI. Don't have to pay off the debt. Don't do anything.
Yeah.
And all you have to do a solo 401k is a small business, and that could be driving Uber for 2 weeks. You're in. Go get a solo 401k.
Yeah, that's a great one right there. And then you don't even have to worry about it. And there's lots of strategies. I've had clients like have other people partner in on the property to pay off the debt, and then they hold it for 12 months. Like, I'll give you 5% of the profits on the sale. That'll be better than me paying this UDFI tax. I'll give you 3%. And so if you have partners and equity that can take out debt, that can help get around UDFI tax. And then the last thing I'll say is just I want you to think about, because some people get hung up on UDFI. I've had clients come to me and be like, Matt, I got $150K in my IRA. I can buy one property with cash that I can get returns on and I'll have no UDFI. Or I can buy 3 rentals and I'll leverage them with debt, but I'll have UDFI on the 3 properties. What should I do? Buy the 3 properties with debt. When you have an IRA buying stocks or mutual funds, you can only buy what you have cash for. You can buy $150,000 worth of stock or mutual funds. But when you have an IRA buying real estate, I could buy $450,000 worth of real estate or $500,000 or more because I can leverage it. But I only pay tax on the debt piece, and it's only capital gains rate when you sell the property. So it's really not that much of a tax. It's allowing me to get greater overall return in my retirement account and grow it faster than if I was just investing the cash. So I still think, despite UDFI for an IRA, it's still a good deal. You're only paying the tax on the debt piece of the deal, and it's only capital gains rate when you sell the property. Yes, you could be paying it on the cash flow of rent, but after all the deductions you take, that's very rare we see that. So I wouldn't get too hung up on UDFI. Know what's out there. You do need to know about. Like I said, it's a chapter in my book. We've had prior webinars just on this and how to calculate it. But think about it as this debt is a tool to go and buy more assets to create more overall return that grows your retirement account faster than you could without it.
Love it. Okay. Gave you so many options there, Gerard. So I think you got plenty to do there. Last question from Michelle, Solo 401k Queen.
Oh,
what an affirmation.
I like that.
I love that handle. Michelle, the Solo 401k Queen. She says, I found Main Street Business and Directed IRA podcasts about 8 months ago and have changed my framework for my retirement planning and my business tremendously since. Thank you for all the value you have added to my life and I share this with my family and friends. Thank you, Michelle. I am so grateful for your podcast. My current question, I have moved both my Roth IRA and my solo 401k out of Vanguard to Directed IRA. Thank you for your business. I'm the trustee of the solo 401k because I wanted a bank account. I wanted to own the control of the bank account.
Makes sense.
I am able to, now here's the real question. Am I able to access high yield savings accounts for my solo 401k while I figure out my strategy for in the next few months? The money is currently at Titan Bank in a checking account, but they don't offer savings accounts with interest-bearing savings accounts. Thank you in advance.
Ooh, I got a good answer for this.
The answer is yes. And what does she do?
I think the easiest for solo Ks is go to Fidelity. Fidelity will let you set up a brokerage trading account in your solo K's name. You're not doing a Fidelity solo K. You're doing an investment-only solo 401k account or 401k account. And what Fidelity basically says is like, hey, you already have a 401k with a provider and you just want to come to us for trading?
We'll take your money.
Or money market? We'll take your money. We'll just open up an investment-only account. And that's what it's called. You just Google investment-only account Fidelity. And now you can be trading stock. You can just buy a money market fund, treasuries, whatever you want. And then you could send the money back to Titan when you want to go do a real estate deal or an alternative asset. And so that's what I've seen the most common. Also, since you have a custodial account at Directed, you could also just buy a money market fund right at Directed. So send the money from Titan back to Directed, and we just put it in your solo K custodial account here, and you can go buy a money market fund. Now, there is a fee for that. It's like, you might have a $25, $35, we do have a trade fee because we don't get payment for
That's
order
one
flow.
trade fee to buy one fund account.
Yeah, and so if you're like, well, I'm going to be in it for 6 months or a year, that's nothing, So look at those options. I think you have a few options there.
And you're going to have trade fees at Fidelity too. It just depends on how much trading you want to do.
You may not at Fidelity because just they get payment for order flow. And so
it depends on what you're doing with it at Fidelity.
So
love it. Yeah, great. Thanks, Matt. Thank you, Michelle, Solo 401k Queen. Well, everybody, thank you. We love the open forum show, hearing your questions. Hopefully you learned something from someone else embarking on the same quest of self-directing your retirement. Grateful to have you here with us. Couple thoughts. We have got to let you know about the Alt Assets Summit. You really need to come to that. It's going to be October 24th, 25th, 26th, 24, 25. It's going to be in Phoenix. You can get to altassetsummit.com. There is a virtual option as well as in-person, but the in-person is incredible because we've got so many vendors and network functions going on. So please get over to that. And then the 360 event. I'm doing my Tax and Legal 360, which is a 3-day event in Phoenix the first week of December. Get to taxandlegal360.com. Matt will be there presenting. I'll be there all 3 days. We've got 15 presenters, 25 to 30 topics over 3 days, food, networking, parties. It'll be a lot of fun, and there'll be plenty of talk about self-directing there, as well as just good business building, wealth building. So lots going on in the fourth quarter. Hope to see you in person. So
yeah, thanks everybody for tuning in. We'll see you next time. Until then, stay calm, self-direct on.